Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath. You know, for the longest time when you heard the name Palantir, you really just thought of, well, shadows?
Right, yeah, like classified briefcases and secretive defense contracts.
Exactly. Just things happening in windowless rooms at the Pentagon
Yeah.
that the general public literally never gets to see. They were the ultimate black box operation.
Oh, absolutely.
But the reality we were looking at today, I mean, it is a completely different beast. They've crossed this massive, undeniable inflection point. They've stepped out of the shadows and just evolved into this absolute high margins software powerhouse.
They really have. And I mean, if you're trying to understand the valuation we're seeing right now, you can't just look at what they do. You really have to look at the sheer velocity of their recent financial pivot.
Yeah.
Because it is, frankly, staggering to witness. Our mission today is to break down exactly how they achieved that fundamental shift. We're going to analyze the technical chart set up following their recent pullback and really evaluate if this is a must-own artificial intelligence infrastructure play for your wealth building strategy.
And I want to dive straight into the numbers, but I want to be careful not to just, read a spreadsheet to you listening, because the context is what actually matters here.
Right, context is everything.
So full year 2025 revenue hit $4.5 billion. That's an acceleration to 56% year-over-year growth, which is up from 29% the year before.
Which is a huge jump on its own.
It is. But the number that truly, it just jumps off the page, is their U.S. commercial revenue. It surged 109% in fiscal year 2025.
Yeah.
And in the fourth quarter alone, it hit 137% year-over-year growth, driven entirely by their artificial intelligence platform, or AIP.
Yeah, the AIP adoption has been wild.
Right. When I look at 137% jump in a single quarter for a company of this size, my immediate thought is just, how is that even mechanically possible?
Well, it's all about this concept called the growth of growth.
Okay, what do you mean by that?
So it's one thing for a multi-billion-dollar company to grow steadily, right? It's an entirely different paradigm when they actively accelerate their growth rate quarter over quarter.
Right, yeah.
What you're seeing with that 137% jump is just the physical evidence of an enterprise adoption cycle catching fire. Because for years, deploying their software was highly manual.
Like very labor intensive.
Exactly. It required forward deployed engineers on site, manually integrating databases one by one. But with AIP, they have fundamentally reduced the friction of that deployment.
I was actually trying to visualize exactly how this shift works for a normal business, and tell me if this makes sense. Imagine a bespoke luxury suit maker.
Okay.
For years, they were the tailor who would measure the client, usually the military, right? And they'd hand-stitch every single operational detail over months and months. It was custom, it was labor-intensive, and inherently just hard to scale.
Right.
But suddenly with AIP, it's like they've engineered this high-speed assembly line that can mass-produce those custom bespoke suits. But they managed to do it without dropping the luxury custom-made price tag.
That is actually the perfect way to visualize it. And that dynamic right there is the textbook definition of operational leverage.
Because they're doing it with fewer people now.
Right. Because they can now deploy their platform faster, and without that massive army of engineers doing everything by hand, their profitability is just scaling at an incredible rate.
Yeah.
In fiscal 2025, their operating margins literally tripled.
Wow, wait, tripled?
Yeah, they went from 10.8% to 31.6%.
That's insane.
And their net margins reached over 36%. Earnings per share surged 163% to 63 cents. So they aren't just bringing in more top-line revenue, The mechanism of the business has changed, so they keep vastly more of every single dollar they touch.
And that operational leverage completely explains their aggressive guidance for fiscal 2026, because management is targeting roughly 61% overall revenue growth.
Yeah, aiming for about $7.2 billion.
Right, with that U.S. commercial sector expected to grow at least 115%. But I have to stop here. I cannot just gloss over this next part, because I really need to push back on behalf of anyone looking to actually put their hard-earned capital into this stock.
I think I know exactly where you're going with this.
Look at the multiple.
Oh, yeah.
It is incredibly steep. The stock trades at a staggering 216.5 times trailing earnings. But even wilder, it is trading at 78.3 times revenue.
Yep. 78 times.
Let me just repeat that for everyone listening. 78 times revenue. Not earnings, revenue.
It's priced for absolute perfection.
Exactly. When a stock is priced for that level of flawless perfection, any slight deceleration growth means we could see severe, punishing multiple compression. If they miss one single target, this stock could get cut in half.
Easily.
And it's not just the multiples either. You have famed short seller Michael Burry publicly calling the stock, quote, wildly overvalued. His core argument is basically that cheaper, highly accessible AI tools from companies like Anthropic are just going to completely eat their lunch. And it makes sense, right? If I can buy a cheap subscription to an off-the-shelf AI, why on earth am I paying millions for this?
And that is the most common bear case on Wall Street right now. And frankly, it sounds highly logical on the surface.
It really does.
But it completely falls apart when you look at how large enterprises actually function. See, Michael Burry's argument assumes that they're just selling a very expensive chatbot.
Right, which they aren't.
Exactly. Generic artificial intelligence, the kind you get from Anthropic or OpenAI, it simply chats with data. You ask a question, it scans a document, and it generates text. But it has no structural understanding of how a business operates.
Okay.
Their primary moat is something called ontology lock-in.
Okay, let me try to translate that, because ontology lock-in sounds like, I don't know, something from a philosophy textbook.
It really does.
If I'm understanding the underlying mechanism here, this isn't just about indexing files. It's like they are building a digital twin of a company's entire brain.
Yes.
They map out the incredibly complex proprietary relationships between entirely disconnected data silos. Am I off base there?
No, you are exactly right. Think about a massive Fortune 500 manufacturer, okay?
Yeah.
Their supply chain software doesn't natively talk to their human resources payroll system.
Right, they're completely separate.
And neither of those systems talks to the real-time thermal sensors on the actual factory floor. But the ontology maps the causal relationships between all of those disparate systems.
Wow.
It understands that a delayed shipment in Taiwan affects a shift worker's overtime pay in Ohio, which then in turn impacts the margin of the product rolling off the line.
Oh, I see. So a generic chatbot from Anthropic might be able to write a fantastic corporate email.
Sure.
But if you let it blindly execute commands across your supply chain, it's going to hallucinate and basically break your entire logistical network.
Exactly. And that brings us to the financial value of this moat, which is the obstruction of data transfer.
Okay.
Enterprises aren't paying for an app. They are paying for the secure, governed integration of artificial intelligence directly into their operational workflows.
Right.
Once a massive corporation maps its entire operational reality into the platform, once it literally becomes their central nervous system, the cost, the friction, and the sheer operational risk of ripping that out to try a cheaper competitor are prohibitively expensive.
Yeah, the switching costs are monumental.
Monumental.
Which makes total sense.
Yeah.
Because if you're a global enterprise, you don't go bargain hunting for a cheaper central nervous system.
Definitely not.
And logically, if this software is plugging into the deepest, most sensitive operational data of a massive organization, the security requirements have to be absolute. You need a vendor with an impenetrable track record, which naturally filters out 99% of Silicon Valley startups. And that brings us right back to the original foundation of this company, right? The government mode.
It is the ultimate barrier to entry. They hold classified clearances and decades of institutional trust at the federal level.
You can't just buy that.
No, you cannot venture capital your way into top secret Department of Defense clearances. It takes years, if not decades, of flawless execution.
And we are seeing that trust convert from temporary contracts into permanent structural infrastructure. Like the Maven Smart system was just recently designated as an official Pentagon program of record.
Which is huge.
It really is. For anyone listening who doesn't track defense procurement, that terminology program of record is incredibly important. It means the software is no longer just a pilot project or some year-to-year experiment that they have to fight for.
Right.
It mechanically converts those software budgets into near-permanent revenue lines. It embeds them into the official budgetary DNA of the military, totally shielding them from competitive low-bid tenders.
It's a fundamental shift in how the military buys software. But what is perhaps even more crucial for their total addressable market is how they're taking that military-grade trust and moving it laterally into civilian public infrastructure.
Yes, the civilian side.
They just secured a $300 million blanket purchase agreement with the U.S. Department of Agriculture for an initiative called One Farmer, One File.
Which is such a brilliant proof of concept. I mean, moving from targeting data in the Pentagon War Room to managing agricultural data at the USDA, it just proves that they are capable of wiring the operational infrastructure of the entire government ecosystem.
Yeah, and we have to look at the macro environment driving this urgency, too. Now, we're looking at this strictly through an objective operational lens, right, without taking any political sides.
Of course.
But the reality of the ongoing Iran conflict and the escalating trade and supply chain tensions with China, they act as massive macro tailwinds. They are forcing the government's hand.
Right. There is an absolute, undeniable urgency for AI in military analytics and supply chain resilience right now. You just can't wait 5 years to modernize your data when global supply chains are actively under pressure today.
Exactly. The geopolitical reality elevates the urgency to modernize immediately. And they're essentially the only vendors standing there with both the proven technological scale and the required classified clearances to execute it.
So airtight government contracts equal a massive, reliable floor of cash flow. The fundamentals are undeniably strong.
Very strong.
But this is where we really have to follow the money, because there is a serious discrepancy I need to address.
Okay, let's hear it.
If this company is perfectly positioned for a multi-year AI supercycle, why are the insiders aggressively dumping their own stock? Let's look at the actual flow of money here.
Okay.
Over the past 3 months, insiders sold $432.9 million in shares. That includes roughly $290 million from CEO Alex Karp and co-founder Peter Thiel. To you listening right now, if you are analyzing a company and you see the founders cashing out nearly $300 million, that instinctively feels like a giant flashing red flag. I mean, are they heading for the exits?
It is a completely valid concern. And, human psychology naturally sees heavy selling as a lack of conviction.
Right.
But to understand what's actually happening, we have to unpack the mechanics of executive compensation and the 10b5-1 trading rule.
Okay, break that down for us.
When you're the CEO of a publicly traded company, you can't just log into a brokerage account and hit sell whenever you feel like it.
Because of insider trading laws.
Exactly. You possess material non-public information. So, to avoid insider trading accusations, executives set up 10b5-1 plans. These are legally binding automated algorithms scheduled months or even years in advance.
But they don't even control the timing.
Nope. They blindly execute sales on specific dates or at specific price triggers, regardless of what the underlying business is doing that week.
Okay, so the selling is on autopilot. It's structural, often for tax obligations or just standard wealth diversification. I get the intent.
Right.
But my counter-argument is that regardless of the intent, it is still hundreds of millions of dollars of physical supply hitting the open market. That inevitably exerts downward pressure on the stock price.
It does create supply, absolutely. But you have to look at how the market is treating that supply.
What do you mean?
Well, if this were a dying company, that insider selling would crush the stock because there'd be no buyers on the other side. But here, you have a massive institutional counterbalance. The smart money is eagerly absorbing those shares.
Oh, like Cathie Wood, right.
Yes. For instance, Cathie Wood's ARK investment bought roughly $11 million of the stock during the recent April dip. Wealth advisors across the board are steadily accumulating positions for their clients.
So they're soaking it up.
Yeah, institutions are perfectly happy to buy the shares the CEO's algorithm is selling because they're looking at the long-term fundamentals. They're looking at what is, frankly, a fortress balance sheet.
Let's actually visualize that fortress. Because when you contrast the $300 million in insider selling against the cash this business generates, the scale really comes into focus.
Yeah, the numbers are wild.
They have zero debt. Zero.
Which is rare.
Very rare. They are sitting on $1.5 billion in pure cash. Their net debt to EBITDA ratio is negative 1.0x, meaning they are completely insulated from interest rate shocks.
Exactly.
But the free cash flow is the metric that truly just stops you in your tracks. In fiscal 2025, their free cash flow was $2.1 billion.
It's massive.
That represents a 46.9% margin. They turn almost half of their revenue into pure, unencumbered cash.
Yeah.
And they're guiding for roughly $4 billion in free cash flow for fiscal 2026. Suddenly, a $300 million automated stock sale looks like basically a drop in the bucket.
It really does. And that level of cash generation gives management supreme operational optionality. They don't pay a dividend, and they do very minimal stock buybacks.
So where's the cash going?
Instead, they are taking that $2.1 billion and aggressively reinvesting it into research, development, and expanding their sales force to ensure they capture as much market share as possible during this AI modernization window.
Makes sense.
Now, it is important to note that they rely heavily on stock-based compensation to attract top engineering talent.
Which dilutes the shares.
Right, it's led to about a 7% dilution of shares over the last 2 years. But because that free cash flow is growing so exponentially, the market is currently entirely willing to digest that dilution without punishing the stock.
So we have a pristine balance sheet, massive institutional buying on the dips, and explosive commercial growth. All of this fundamental reality leads us directly into the current technical setup on the chart. What are the actual price levels and psychological markers you need to watch over the next few months?
The technical chart right now is telling a classic story of psychological reset and accumulation. The stock had a historic, massive run, eventually peaking at $207.52 back in November 2025.
I remember that.
Yeah, and what followed was a 30% pullback, bringing the price down to a consolidation range between $146 and $152.
And look, a 30% haircut is terrifying if you don't understand the underlying fundamentals of what you own.
Oh, absolutely.
But mechanically, that kind of pullback is exactly what shakes out the weak hands. It flushes out the speculative tourists who just bought the hype, leaving the shares in the hands of high-conviction long-term investors.
Precisely. It clears out the speculative froth, which creates a much healthier foundation for the next leg up. And we are seeing the momentum physically return to the chart.
The moving averages, right?
Yeah, the stock recently broke back above its 50-day simple moving average, which currently sits at $143.96. Furthermore, in mid-April, the MaxLend indicator crossed above the 50-day moving average.
Let me jump in and translate that MaxLend flip for a second. The moving average divergence indicator isn't just a squiggly line on a chart. It measures human market psychology. When the MaxLend makes a bullish cross like that, it visually represents the exact moment when the aggressive momentum of the sellers is finally exhausted and the buyers are stepping back in with enough volume to take control of the trend.
Exactly. It marks the shift from distribution back to accumulation, and we have the volume data to back up that shift in sentiment.
Right.
When the USDA contract was announced, trading volume immediately jumped 4.3%. Buyers stepped in aggressively on the fundamental news.
But there's still some resistance, right?
Yes, it's not entirely clear skies just yet. The 200-day moving average is still looming overhead at $166.28. That level is going to act as a significant psychological ceiling or resistance that the stock will need a major catalyst to break through.
And that catalyst is coming up fast. May 4th, 2026 is their Q1 earnings report. The street consensus is expecting 26 cents in earnings per share. But the EPS isn't the real test here, is it? Management has to get on that conference call and definitively prove the mechanics of the growth of growth narrative. They have to show the market that the 61% revenue growth guidance for 2026 is fully supported by the actual sales pipeline.
It is absolutely a show-me quarter. The market is paying a premium multiple, so it demands premium execution.
Exactly.
But there are leading indicators suggesting the pipeline is robust. We recently saw the launch of Vanyer, which is a third-party specialist firm dedicated entirely to integrating their AIP platform for other companies.
See, that specific detail reminds me so much of the early days of Salesforce.
Oh, 100%.
When an ecosystem of third-party consulting firms organically pops up just to help other corporations implement your software, you know you've transitioned from being just a singular product into becoming a foundational industry platform.
Yeah.
You were letting other people do the heavy lifting of lowering the implementation friction.
It's the ultimate indicator of long-term staying power in the enterprise software space.
Okay, so we've covered the fundamentals and the technicals, but I have to bring up the speculative rumors because my mind is completely blown by this concept.
I think I know what you're going to say.
There is unconfirmed chatter circulating that they are partnering with SpaceX and the defense contractor Anduril to pitch a coordinated defense system dubbed the Golden Dome.
Yes, the Golden Dome rumor.
We are talking about the potential for a subscription model defense contract worth potentially hundreds of billions of dollars. A subscription model for a planetary defense shield.
It sounds like sci-fi.
Right. Can you even imagine the recurring revenue mechanics of a software-as-a-service contract applied to national defense? It is wild.
It is an incredible concept. And if it were ever to materialize, it would represent an absolute paradigm shift in how global governments procure defense infrastructure. But as an analyst looking at actionable data, I have to anchor us back to reality. The Golden Dome remains unconfirmed speculation. What is tangible and what institutional capital is actually positioning for right now is that May 4th earnings catalyst. And we are seeing the analyst community aggressively align with this momentum.
We've had a lot of upgrades recently.
We've seen a massive wave of notable upgrades. Mizuho upgraded the stock to outperform with a $195 price target. Daiwa upgraded it to a buy at $180. Rosenblatt reiterated their buy rating with a $200 target.
Wow.
And Morgan Stanley, while keeping an equal weight rating, still raised their price target to $205, explicitly highlighting a strong setup heading into this earnings print.
So bringing all of these complex threads together, the explosive commercial growth, the impenetrable ontology moat, the government contracts, and the technical accumulation, what does this mean for you and your wealth building strategy?
Right.
The investment thesis here earns a very strong 8 out of 10 bullish score. When you strip away the lingering mystique of the shadow company era, they are methodically establishing themselves as the infrastructure monopoly for operational artificial intelligence.
Absolutely.
They are the only bridge between chaotic siloed data and real-time secure decision-making at scale.
And because of that unique positioning, the actionable play here has two distinct timelines.
Okay, let's hear them.
For the active wealth builder, the current technical setup, specifically that Manhattan Cross and the clearance of the 50-day moving average, offers a highly compelling swing trade opportunity heading into the volatility of the May 4th earnings.
Right, the short-term play.
But structurally, when you look at the multi-year AI adoption supercycle and the immense switching costs of their ontology lock-in, this stock absolutely demands consideration as a core long-term holding within a growth-focused portfolio.
It is rare to find a setup that satisfies both the momentum-driven swing trader and the fundamentals-focused long-term accumulator. But I want to leave you with a final, slightly provocative thought to chew on today. We've detailed their massive acceleration in the U.S. commercial sector, and we've unpacked their deep-rooted defense contracts. But if they successfully achieve this trajectory, if they truly become the undisputed operating system for both the U.S. military apparatus and the broader commercial enterprise market, seamlessly connecting the data of the Pentagon to the agricultural supply chain to the Fortune 500 corporate sector, well, at what point do they transcend being just a highly valued software vendor? At what point does this company become a critical, too-big-to-fail fourth branch of operational government?
That is a deeply fascinating and perhaps slightly terrifying structural question to consider as this AI cycle matures.
Something to carefully mull over while we watch the charts heading into May 4th. Thank you for joining us for today's analysis. Stay curious, stay informed, and we'll see you next time.